Welcome to Sawyer Silver Value. And if you're watching this right now, you've already noticed the smoke in the crypto market. But here's what most people don't realize yet. What happened overnight wasn't just another Bitcoin dip. It might be the single most telling price signal we've seen since the ETF approvals. Stay with me, because by the end of this update, you'll understand exactly who is selling, why institutions are suddenly pulling back, and the one level Bitcoin must hold to avoid a much deeper slide. Let's get straight into today's Bitcoin price action. Over the last 24 hours, Bitcoin has been trading inside that volatile $66,000 to $72,000 range we've grown used to. But this morning, we broke below the lower bound, briefly touching $65,800 on heavy volume before bouncing back to around $66,400 as we record this. That's a 4.2% drop from yesterday's local high. And here's what matters. This isn't a standard pullback. On-chain data shows this move is being driven by two distinct forces: institutional selling pressure and a sudden shift in market sentiment from greed to outright fear. So why is Bitcoin moving down today? The short answer: ETF outflows. Yesterday alone, US spot Bitcoin ETFs recorded net outflows of nearly $290 million, led by Fidelity's FBTC and Grayscale's GBTC. That marks the fourth consecutive day of net outflows, something we haven't seen since late April. When ETF demand dries up, the spot market feels it immediately because market makers have to unwind hedges. And right now, the sell-side pressure is snowballing. But that's not the only headline. Just 2 hours ago, a major European asset manager, name not yet public but confirmed by on-chain sleuths, dumped over 4,000 BTC from a wallet linked to their digital asset custody arm. That's roughly $265 million in selling pressure hitting the market in a single batch. Whales are watching this closely, and the response has been defensive. Large holders have moved over 18,000 BTC to exchanges in the past 12 hours, according to CryptoQuant. That's the kind of behavior we typically see before a larger move down. Now let's talk about the broader economic backdrop. Today's US durable goods report came in softer than expected, but more importantly, Fed commentary from Minneapolis President Neil Kashkari suggested rates may stay higher for longer than markets had priced in. That hit risk assets across the board. Nasdaq futures are down 0.7% and Bitcoin, still acting as a high beta macro asset, got caught in the crossfire. The CME FedWatch tool now shows only a 52% probability of a rate cut by September, down from 68% just 1 week ago. For crypto, higher for longer rates mean less liquidity, and less liquidity means more violent downside moves. But here's where the story gets really interesting. Look at the options market. Deribit data shows massive open interest building at the $60,000 strike for June 28 expiration. Market makers are now hedging that downside, which creates a feedback loop. Every time Bitcoin drops, dealers sell more futures to stay delta neutral, pushing prices even lower. That's exactly what we're seeing right now. And yet, and this is the curiosity gap most analysts are missing, the funding rate on perpetual swaps has actually turned slightly negative. That means shorts are getting crowded. If we get even one bullish headline, we could see a violent short squeeze back towards $69,000. So what are the experts saying? A quick survey of institutional notes from this morning. QCP Capital is warning that a daily close below $66,000 would open the door to $62,500. On the other hand, Bitwise's head of research notes that historically, 5 consecutive days of ETF outflows have preceded a bottom within 72 hours. Meanwhile, Arthur Hayes wrote this morning that he sees maximum pain for bulls if Bitcoin retests $60,000 before rebounding into summer. Let's not ignore the elephant in the room: miner selling. Post-halving, the hash price has dropped to $0.09 per terahash per day, the lowest since October. Smaller miners are being forced to sell their Bitcoin just to cover operating costs. In the last week, publicly traded miners alone have added nearly 3,000 Bitcoin to exchange balances. That's more supply hitting the order books without a corresponding increase in spot demand. So what happens next? The immediate support at $65,500 is being tested as we speak. If that breaks, the next real liquidity zone sits at $62,800 with a massive cluster of stop losses just below $62,000. On the upside, a reclaim of $68,500 would flip short-term momentum back to bullish. But given the institutional selling pressure and weakening ETF flows, the path of least resistance for today and tomorrow still points lower, unless we get a major catalyst. And that catalyst could come from an unexpected place: tomorrow's PCE inflation report. A cooler than expected number would reverse the rate hike fears and send Bitcoin ripping back towards $70,000. A hot number? Then the $60,000 level becomes very real, very fast. Before we wrap, here's your takeaway for today. Bitcoin is caught between macro uncertainty, ETF outflows, whale distribution, and minor capitulation. The $66,000 floor that held for weeks is now cracked. Sentiment has shifted from greed to fear on the Crypto Fear and Greed Index, down to 34 from 68 just 10 days ago. But remember, in crypto, the darkest hour often comes right before the reversal. Institutions aren't leaving, they're waiting for lower prices. The question is, will you be positioned for the snapback or caught chasing it? That's the latest on Bitcoin price action, ETF outflows, institutional moves, and what to watch next. Stay disciplined, stay informed, and as always, never make emotional trades based on a single day's move. For more amazing videos like this, subscribe to our channel, Sawyer Silver Value News.